Good morning, everyone. We're at 11 o'clock. We're going to get started. I'm sure we're going to have more people joining. We had a really good crowd yesterday for the first part. So let me start by introducing David Key. He is a licensed agent and consultant, primarily assisting seniors on Medicare and Medicare plans. Dave has over 55 years of experience in the health insurance industry. Dave served as a Blue Cross Blue Shield of Michigan vice president for the National Chrysler account, where he had responsibility for an estimated 30,000 Chrysler salaried retirees. He also had responsibility for the UAW retiree program for about 500,000 UAW retirees. And upon his retirement in 2008, Dave formed Double Health USA, dedicated to helping seniors on health care issues. Among his clients are approximately 300,000 retirees of the International Association of Machinists and Aerospace Workers and the NCRO. David worked with the NCRO and NCR members for over 15 years. Dave has an MBA in Insurance and Risk from Temple University and an MBA in Marketing from Wayne State University. And he also served us in the U.S. as an officer in the U.S. Army. Thank you very much, David, for your service. And at this point, we have about 20 people on the webinar. So we're going to get started with part 2 because I know David has a lot to cover today. So with that, David Key.
Thank you, Dale. Thank you for that introduction. Wanted to kind of first kind of go over a little overview of what we talked about yesterday, and this is won't take too long, but just to get you up to date, just like watching one of these serial shows on Netflix or HBO. Okay, let's see. Okay. Don't seem to be able to move here. Dale, I don't seem to be able to advance the screen. Should I?
You should be in control. You're in presentation mode?
Yes. There it goes. Oh no, that still can't move it.
Why don't you escape out and restart it?
Okay. All right, let's see. Okay. Yeah, there it goes. Yeah. Okay.
Sometimes you gotta hit Microsoft with a hammer.
Well, what I'm going to do is just a little recap of what the presentation is about. Yesterday we covered 2 things, and that was kind of an overview of long-term care, and then what your options were. Do you use home care? Do you use assisted living? And that'll give you a little option. I'll just go over a couple of those things. But then what we're going to talk about today primarily is you have some idea what long-term care is. You have an idea of some of the risks, and then how do you fund this? What programs are available from the government, Medicare and Medicaid, and what are private ways of handling it? And then we'll spend a little time just saying, okay, how do you develop a strategy for long-term care? Because it is a complicated one. So let me just go through, and I'm going to be clicking through kind of quickly, saying just some of the things we had. We talked about what long-term care is. It's the cost of long-term care. I'm just really rolling through this, but I think there is a copy of this whole presentation that's available, and the whole presentation will be recorded as well. I just want to draw your attention to a couple things. Just an idea of saying, well, what will this cost me? And then there are a couple things we have, and these are averages. And this is something that was done by Medicare, the Health and Human Services. They had a very elaborate model in 2022, and they said that most people turning 65 will incur, on average, $120,000 in long-term care costs. That means that a lot of people may have little, but some people may have a lot, and this is an average with this. Another study said 172,000 with this. So it's really it's a number that is not as firmly set out there. But I want to show you one more thing before we get started on the second part of the presentation, and that is this little chart here. This chart is something that was done by Price Waterhouse, and basically what they did is they looked at insurance company claims for long-term care. They said, well, what are these? How much are these claims worth? And if you look at here, it says, okay, but this is for every $50,000. So if you look at here, it says, okay, this is $100,000, and keep in mind this is 2017, so it's gone up. It's gone up since then. But it said, well, 52% of the probability of exceeding 100,000, which is a low number, is about 52%. So it's kind of in the middle, or somewhere between 100 and 150,000, maybe raised by by some amount here by inflation. But just to get an idea, saying, okay, well, what on average, what's this going to cost me? It's going to be somewhere between 120 to 170,000 dollars, somewhere in that range. But again, it's average, and you can see that the other thing to look at is that most people will probably not fall into the larger categories. You look at 400,000, only 12% will be, only 12% of claims will be more than 400,000, and you get longer, and you see that's a small number. So if you're in the top end, you might be okay, but if you're in the bottom end, it could be kind of catastrophic depending on how you plan for things. So with that backdrop, once you just kind of go through, and now we're going to really whip through these and all the presentations, and see what's out there, and looking at the different ways of handling your long-term care, all the different programs that are out there, strong points and weak points. Adult daycare centers are one of them, assisted living and memory care facilities. These are describing just what they do and the relative issue, the strengths and possible issues with each one of these approaches for how you handle this. Okay, so now we're going through everything, and you won't spend the whole time with that. It took us about an hour to go through those before with all these strong points issues, but you can get an idea of what we're looking at. Progressive senior facilities. And we're now going to start with a new presentation. Well, and this is what are the options to fund long-term care costs. And we're going to go through government plans, and this is going to be mainly Medicare, Medicaid. We're going to look at some of the things you consider from your own income and your own financial assets, I should say. And then a little something that may be a little more surprising, leveraging your home to finance long-term care costs. Now, all in this, I just a little caveat in here. I'm not a mortgage broker or anything like that. So I'm approaching this, but I think it is important that you have this information. And then if you decide that's something you want to do, then you'd have to really get a hold of it, and somebody's really licensed and certified to look at that and look at all the details of that. But then we'll spend probably a good bit of time on long-term care insurance products to fund this, to say, well, what are the ways to do this? Why should you do it? And what do they look like? Okay, we'll start off with the government plans for long-term care. And I mentioned Medicare is one. And what does Medicare pay for? We'll discuss this in detail in a minute. What does Medicaid provide for long-term care? And we'll get into a little description of some of these programs that are out there. Now, I am not a certified license, or I should say, I'm not a government representative for Medicare or for Medicaid. So I'm giving you this information as kind of an informed, I guess, third party, or someone who will give you the information as best as I have it. But I'm not the official word on Medicare and Medicaid, even though I think I've done a lot of research on it. And one other thing I want to add for this, for anybody who is a veteran or who has VA benefits, I think it's very important to check to find out if you're eligible for any VA benefits. For instance, I had one client who had nothing else to really work with other than Medicare and perhaps Medicaid, but he did find out that he had served in the military for a short period of time, but he had in fact left for the service. He thought it wasn't a service-related disability, but the VA counted it, so he actually had some VA benefits. So it's just a check to say that check the VA if you have served in the military. check to find out whether you have any VA benefits. And they're complicated rules, and they're beyond what I know or understand, and it's always a good thing to do it. Okay, well, what does Medicare provide for long-term care? Well, they do cover a limited amount of long-term care services. You can think of what some of the things long-term care covers. It covers things like it covers like what happens if you need a homemaker, or you need a nurse to come to your house, physical therapy, things like that. It covers a long range of things, but Medicare covers a limited amount of long-term care expenses. But if you you look at the nursing, but probably the biggest hit for long-term care is when you have someone come to your house and provide those services, and that is not covered by Medicare. It's kind of the custodial care. It's something like you need someone to check up on you. You might need somebody to help you get in and out of bed, incontinence issues, and those types of in-home services are not provided by Medicare with it. But also assisted living and group homes, which are assisted living is just what's assisted living. That's really quickly. I'll say that you have nursing home care when you need to have. You've got not only can you need a lot of help in your activities, but you also need medical treatment. It could be a catheter, it could be IVs, things like that, and that's a nursing home. That's the most expensive part. And they have what you have on the other end. If you're at home and you can do a few things and do some things, but you need some help. In the middle is assisted living, and assisted living is somewhere where you're not ill enough to need constant medical care, but you can't live alone with that. So that's a quick summary of assisted living. It's not really clearly defined by our purposes to think it's somewhere in the middle. And for this part, it is really assisted living is not covered by Medicare. Group homes are another or smaller version of kind of a family version of assisted living, and it's not covered by Medicare either. And nursing homes are not covered by Medicare, except if you go into the hospital and you, let's say you've had a stroke, something terrible like that, you have skilled nursing facilities, because at some point, if you have a stroke, they won't be able to do too much more for you in the hospital, but you can't go home at that point because you need some medical attention with that, not just custodial care. And Medicare will pay for skilled nursing facilities. Skilled nursing facilities could be in your home, it could be in a facility, which will actually provide these services, these medical type services, and Medicare pays up to 100 days for that. So in fact, Medicare does pay for some long-term care costs, but the biggest one is that they won't pay for the nurses who are coming to your house. If you're in a skilled nursing facility, you're going to get nursing care as well. So you have some of that, but it's all related to hospitalization, and really long-term care for the most part is anything related not to a hospitalization. Okay, Medicare also covers durable medical equipment such as hospital beds and wheelchairs. And there are some Medicare Advantage plans that cover some long-term care of the nurses' aides coming to your house as well. But they're very limited, and it looks like Medicare Advantage plans are going to have to tighten their belts a little bit. It's unclear whether that's going to be something they cover in the long run, but it's limited. It's nothing that's going to really, you can't count on Medicare, even the Medicare Advantage plan, to cover extensive home custodial care. And you weren't aware of it, but there's also a program that Medicare program called PACE program, which was described previously. I won't go into too much detail other than to say it's a program that will assist people who want to trade in their Medicare for a specialized program that especially for long-term care, people who are living at home. There's a program for that. And if you have questions on that, we can address it later, or it also is it's described in a lot of detail in our first session. So you can see that Medicare doesn't cover a lot unless it's associated with a hospitalization. If it starts with a hospitalization, Medicare can pay a lot, but once you get to the point where you're no longer qualified for skilled nursing, and the whole thing about skilled nursing is you have to be in a position where they can kind of improve your health. If you reach a level and you still have issues, you can't take care of yourself, then that's when Medicare will be cutting off. Well, let's talk a little bit about Medicaid. And again, I'm not a Medicaid expert, but this is something that you should know for this, and it is a program that really does cover a lot of what long-term care costs are. Medicaid is something that's administered by each state, and it's really funded in large part by the federal government. Their eligibility requirements are state-specific, so even though there's more commonality than there used to be, but each state is different. What's available in Michigan is not the same in Louisiana, or vice versa. Most states use the activities of daily living, and that was what we talked about in the first session. And what does activities of daily living mean? It means it means things that you need to do in every day, like continence, getting in and out, up and out of bed, eating, all the things that you need help with, that you have to live in your life. And there are, I won't go through it again, but there are 8 of them that are commonly out there. But these activities of daily living, or a mental impairment like Alzheimer's, is what they will use, that Medicaid will use to establish your eligibility for Medicaid. Now, the thing about Medicaid, it is designed for low-income beneficiaries. And so if you're not a low-income beneficiary, which probably most people listening are not, then in order to qualify for Medicaid, you basically have to you have to meet certain income levels, and you have to have a low amount of assets to qualify for Medicaid. So if you have a lot of financial assets, 401ks and pensions, well, pension so much, but you have other issues, then you will have to kind of reach a level where that you're in a situation where you're low income. If you're not basically low income and you're middle class, or you're somewhere in that range, in order to get Medicaid, you're going to have to drop down to a level of a low income, a low asset individual. And that's the rub about Medicaid. And so we're again mentioning the income and asset limits. We want to maybe just give a little idea of what this means. Well, what is the income limit? In Michigan, it's $2,828, which is probably much less than most you're making. Also, the asset limits are $2,000 for an individual, $3,000 for a couple. And we'll describe, but there are some exceptions to that. But basically, you're looking at saying, well, your income is going to if it's much higher than that, your income is going to be kind of eaten away for this, and also your assets are going to be drawn down to your at the $2,000 individual or $3,000 couple limit. But Medicaid does pay for nursing and nursing home and skilled nursing care facilities. But when you get to assisted living, sometimes it may not cover assisted living, because Medicaid was designed only when nursing homes were the only option, where assisted living didn't really quite exist. And so it may cover some of the expenses for assisted living, but the big expenses for assisted living are going to be room and board charges, which are kind of broad in most cases. And so it'll cover, but it won't cover that. And that's where you're going to be. That's where your cost would be for assisted living. It does work with some adult daycare centers and some of the other programs. In Medicaid, you actually can get in-home services for people who are nurses' aides and others coming to your house to help care for you. And the program varies by different states, and it's a different thing. Michigan, for instance, does have something that says, okay, you can use Medicaid to actually pay for in-home care, and you have to, even though with that, you have to look at what's available. And right now, there's a big, if anyone is unfortunately in a situation where they've had to look at aids, they're getting very more and more scarce and hard to get a hold of. But Medicaid does pay for that. That's the important thing. Now, the other thing about Medicaid is not all healthcare facilities are going to accept Medicaid. So you have to really look at this, and somebody may limit the amount of Medicaid residents. Like some facility might say, okay, well, we handle Medicaid, but we only have 5 beds, something like that. So you have to really look at this. You have to look at Medicaid facilities. Is this going to be what this level of care that's acceptable to you and your loved ones? And you have to find out whether or not they accept Medicaid. And some will, some won't. And again, I mentioned assisted living charges. Assisted living rental residence charges are not payable by Medicaid. Well, just a little discussion on assets, and this gets a little bit in the weeds, but I'll kind of walk through this a little bit. Because remember, you could only have assets that were very limited, and that's $2,000 or less in cash. So if you have $2,000, under $2,000, Medicaid won't use that as qualification for that. It doesn't also include your personal effects and household goods. And it also does not include your equity on your home. It's up to $713,000. So for most people, Medicaid doesn't necessarily, you don't necessarily have to move out of your house if you have Medicaid. And also you have a vehicle if you use a vehicle, that's Medicaid won't go after that. And life insurance, you can have a very minimal amount of life insurance, $1,500. So you can see, if you look at this, it looks kind of saying, this is the kind of level you're gonna have to reach before you, if you want to go to Medicaid. And also, if you have a joint bank account, and the thing is, with Medicaid, often you have one spouse may need to have Medicaid services, and the other one may not. So if you both, for instance, have a bank account, then that one is not included if there's a joint bank account. You have to get a little into details with this if you ever get in that situation to find out exactly what that means. And also, if you have real estate, that doesn't, as long as you try to at least try to sell it, it doesn't necessarily count against Medicaid, which is a little surprising. There's also something called a community spouse resource allowance. And what this means is that if you have one spouse who needs Medicaid, is in maybe some kind of facility, that the spouse who is not receiving Medicaid can exclude over about $130,380 for the non-institutionalized spouse. So, it's because you think about your situation, probably a lot of your assets, over a couple or joint, and if that's the case, then you can have $130,000 of basically for 401k or whatever those assets are to help the non-institutionalized spouse to help out. And there's also something called a clawback, which I wanted to mention. And basically is that it used to be in Medicaid that you could go back and say, I'm going to apply for Medicaid, so I'm going to give all my assets to someone else so I can get them out of here so that I can now qualify for Medicaid. Well, they changed the laws a while back and saying, okay, if you decide to do that, let's say the day after when you're applying for Medicaid, that's not going to work. You have to, if you're going to transfer assets, it has to be more than 60 months or really 5 years. So if Medicaid is where you'd like to, your endpoint, you have to get rid of those assets, you have to transfer those assets 5 years before you apply for Medicaid. Now, of course, the issue with that is that whoever you transfer the assets to, you have to be able to have enough trust that if you need them, they'll help you with it. And, unfortunately, sometimes hopefully that's going to be the case, but unfortunately, sometimes it is not. Now, there's another thing that we'll talk about. It's called a long-term care insurance plan. It's called a state partnership plan. And if you get basically, if you have benefits from that kind of long-term care insurance, those would not be counted against the assets. So that's something that helps preserve your assets. But we'll go into that in a little more detail. Okay, but assets, just to say, this really includes a lot of the combined assets of not only the person who needs the care, but also their spouse, except for some of the exceptions we made. And all of these assets, again, except for these exceptions, need to be spent down to apply for Medicaid. One other thing that is not assets, but you also have something called a community spouse monthly income maintenance limit, which means that you could have the spouse could have up to $3,259 a month to basically live off of, because if you're the non-institutionalized spouse, you still need to live, and then you do have some limit for that, but it's limited. Okay, what are the strong points and issues of Medicaid? Well, it covers almost all the costs of institutional long-term care. It's available to everyone, low income or it might be, and it's the other thing is that if you decide to do nothing with long-term care, it is a backup that you have if and you're in that situation, and now you just don't have enough assets to cover this and you need help. You can do that. That's it. And again, remember looking at that little curve we showed, it's going to be the minority of people who are out there. But if you are in that minority and you end up with a catastrophic situation, you can apply for Medicaid. But with all those restrictions that we talked about, the biggest thing is you're going to spend down your assets and your income. Some of our issues with this, well, the spend down, just as we've talked about. You can spend down your assets and income. And you have to also look at the limitations of Medicaid providers. Medicaid pays institutions probably much less than the cash customer, but so some facilities can work off that, some may not. So you really need to look at that to find out. You need again to look at that to find out whether or not you're going to be able to get the facility you like, or even the level of care you like. If you use a home health agency, for instance, you need to talk to them about whether they will accept Medicaid reimbursement, and some will, some won't. Okay, and the home-based care, we mentioned that Medicaid is moving into home-based care. This is for nursing care at home or aid at home, and it's not always the same. If anybody's listening from other states, it could be different in some areas. And the other thing is assisted living room and board charges are usually not paid by Medicaid. So that's if you're in an assisted living facility, that one is not going to be picked up by Medicaid. And there are some ways to figure out how to get the Medicaid faster with maybe preserving some of your assets. But if you want to look at some of those programs, you really need to talk to an elder care attorney. I don't go into this because I think it's those ways of looking at trying to shield your assets are need an attorney, because if you don't do it exactly right, then you could really really lose the whole thing with that. So that one, if you really say, Medicaid's really what I want to go, what's the best way to preserve assets, then I suggest you talk to an attorney with that. By looking at your own financial assets and income, and that's an important thing to remember, is that hopefully most of you have a pretty good income, or at least a sustainable income now. And if you need Medicaid, need long-term care, you need to look at how these your income and your assets can help. And we're also, beside looking at your assets, we want to look at maybe something that is not looked at looked at quite as much, and that is terminating life insurance to fund long-term care costs. Now, many of you may have life insurance now with it, and there are certain things you can do with that are not commonly understood. So it's really your income that you're getting now as a retiree, your assets. How do you look at this? And this one is again, it's your income is your first line of defense. Just some of the things to think about when you're looking at this is that are there changes to your income? Like if there's depending on, say, some pension plans might say, or some annuities might say, okay, they'll pay if it's a couple, they might pay a certain amount, but if one spouse dies and then maybe the other one gets 50%, 75%, things like that. So you have to look at what your income might be due to things like deaths of one of the spouses. You need to look at some of your your long-term care costs if you're staying at home. Your income is, you're looking at your income, but your cost, you're also kind of looking at your cost. And there's a lot of costs for living for a home beside having the nurse assistance. I mean, your home care supplies that you're needing, that you need, especially in incontinence situations, maybe even home modifications. So you have to need to look at that, not so much for income, but this is cost side of things. And you also, getting for cost, you have to realize that if you're in a situation that if you say, well, I want to go to, if you look at things like that, you want to remain at home, you have to look at things like your ongoing property taxes, your home maintenance. These are costs that are things to look at too. And again, it's not income, but it'll result in net income. But some of the expenses on the other side, you might have some reductions. For instance, if you go to an assisted living facility and they include meals, your food expenses should be very minimal. And so you might want to look at these things, trying to get some handle on what is out there, what is your income, and how that might be affected by a change if you need long-term care. So you can get a better idea of that if you go through the income, you get at least a first start to say, well, how much do I really need to protect against? And we'll just talk a little bit about your assets. You need to look at your assets. I mean, obviously, you need to see what you have, and you also need to look at assets that are available for covering long-term care. For instance, if you're thinking, well, maybe you're already drawing on a 401k or something like that, then that's not going to be available for long-term care unless you want to take a big drop in your income for that. So you need to look at those assets to find out, are those assets, especially their income producing, you're counting on that for your lifestyle and your living. You may not want to touch those, or you may want to modify those. But the biggest thing is that they probably won't be available for long-term care unless you want to make some changes to that or your lifestyle. So again, it's not going to be available for those, and you have to think of long-term care as something that is outside of it'll kind of remove your assets, for lack of a better word. When you get in that situation, cash is always king with long-term care expenses, and so if you have cash, you're going to move ahead of the line before any Medicaid recipient for the most part. And so it's important to have those. And of course, it's going to be cash flow dependent on how liquid your financial assets are. And sometimes if you're looking at, if you have substantial assets there, you might say, okay, maybe it might be worth putting all of those financial assets under one umbrella. And if you're going to be spread out over a period of time paying these assets out, you want to take as much financial advantage you can for those assets until you draw them down. Okay, so but once you look at this, once you look at your income and assets, then you get an idea of and your expenses, you get an idea of what you're looking at. And everybody's got their own story with this but it's important to maybe start from there. Well, now we'll get into some of the things, how you can fund long-term care. And terminating life insurance, probably a lot of people don't think about this, but you've seen on TV ads for saying that you have this life insurance, it's an asset, you can sell those, and you can actually get money back for it. Now you think about this a little bit. Well, what is life insurance? Why would a company do that? Well, because let's say you have an insurance policy that has a $200,000 face amount, and it says, well, upon your passing, the beneficiary, you have $200,000 out there. And so let's say also, the life settlement company will give you funds for long-term care, but there's also something in life insurance called a cash value. And basically, cash value on life insurance says, okay, this is if you have permanent life insurance, that if you decide that you don't want to wait until you pass on, but you want to take it in cash, then you take the cash value, you can take an immediate cash value for that. And there are different terms of how you do that, depending on the insurance company. But so these life settlement companies, they'll say, okay, well, let's say it's $100,000. Let's say it's $100,000. Make the math simple. That's how much you would get for your face amount for life insurance. but your cash value, if you just decide to cash it on your own, is $50,000. They might say, well, they'll look at it and say, well, what is if they pay $60,000 for that, for instance, then they're kind of betting on, okay, I get $60,000. This is a settlement company, but then I pay $60,000 to get $100,000 or something basic like that, something like that. So they're betting, I don't say foolishly, but it's kind of betting on your passing is how they will do that. So you have to look at that to find out. But it's for a lot of people, if you do have life insurance, it is a possibility. Now, also something, just a little hint, doesn't kind of squeeze it in here, but some policies, if you have a terminal condition, that you might have a policy that'll pay for some of your long-term care expenses for that, and that's so that might be something that you might need to look at to see if you have this in your existing life insurance, if you have it. Okay, another thing to look at, and this is saying, well, what if you have this life insurance? Should I turn it in? Should I get them if I get the money? Another thing is that if you have existing life insurance or an annuity for that matter too, there's something called a 1035 exchange. And basically what this is, and this thing is that you have one of these older policies, and we're going to talk about some of the newer policies that provide long-term care protection, some of it pretty extensively. You can basically exchange some of these older policies for a newer one that can provide long-term care. And we'll go into that in a little detail, but I should mention that when you're looking at this, you're looking at if you have life insurance and saying, boy, I could use this money, it probably is not a bad idea to say, okay, is it worth converting this life insurance, getting whatever life insurance settlement company can give me, or is it better to go back and change the policy that you have, which you're probably not thinking too much about, into something that can provide you long-term care benefits. Okay, now let's talk about the house. The house is probably maybe sometimes your first line, maybe your last line of defense, but for most people, your biggest asset is going to be your home, if you're fortunate enough to have a home. And there are ways you can monetize that asset with that. And we'll go through those. And we'll go through, and that's one of them is selling it, but there's also something called a reverse mortgage. Now, reverse mortgages, again, I'm not a mortgage broker, so I'm just going to talk to you kind of as an informed layman about this, but there's at least it's something that you should at least consider. I'm not going to be talking also about home equity loans that you can have. If you have equity in your homes, and some of you already have these called HELOCs, home equity line of credits, things like that, because it's not really if you do have those kind of loans out there, eventually you're going to have to repay those. So I'm just not going to get into the whole issue of saying, well, okay, is this a way that you can finance things? It could be, as long as you have a way to pay back that, because that is really much more like a regular loan. Okay, well, you're selling your house. What is the strong points of that? Well, one thing, if you sell your house, you get 100% of the equity value, after commission and fees. And that's what you have for long-term care with that. Now, this equity could be substantial, but the possible issues with this, that once you sell your house, well, you're going to have to move to somewhere. And it's if it's an assisted living facility, and maybe that's where you need to go, then that's not so much of an issue. If you have someone is living in the house, and it's still one spouse needs to be institutionalized, the other is not, then it may not be quite a good idea unless there's a place for the non-institutionalized spouse. And probably the biggest thing about selling your house is that probably the biggest generator of generational wealth is the equity of the home. And of course, once you sell it, then that equity won't be passed down to the next generation. And mention if your spouse remains in the house, that's not going to work out too well. Let's talk a little bit about reverse mortgages. Again, I'm not a mortgage broker, but just to give you an idea of what this is. Now, you basically get something based on your home equity. Now with that, so whatever is out there, you can get a lump sum or monthly payments. It can never, if you have a loan, it can never exceed the home's value, even if the home value drops with this. And it's typically the loan value is like 40 to 70% of the home value. Probably the older you are, the more you'll get the value of your home, but you won't get the 100% if you sell it. You'll get somewhere less than that. You have to be age 62 to qualify. All home equity loans, all reverse mortgages have to be FHA approved. That's a Federal Housing Authority, and there are different rules about how these are set up. So you have some protection for that. And as long as one borrower lives in the home, it doesn't have to be repaid. But the loan will be repaid when you leave the home or the last surviving spouse passes away or moves. It's much higher closing fees. And the biggest thing, if you decide you want to do that, you have to remember you're still responsible for property taxes and also for maintenance. But it could provide costs for long-term care. And the biggest thing about that is that you can still live in the home with that and still get some income with that. So, but it's your equity. So if you have other things that are if your equity is not, if you don't own it 100%, then it's all your equity you're talking about, not the value of the house. And the other thing is, the biggest thing is you can stay in the house, and you have FHA to help regulate the loans. And the next other thing, if the house goes upside down, if the loan is raised on $200,000 and now it's only worth $150,000, you're not going to be responsible for that shortage if and when the house is eventually sold. Possible issues with this. Well, again, this loan not to be repaid, and you lose that whole family generational issue, and the home equity may not be enough for long-term care costs. And the proceeds, if you do have a home equity loan, you have to, if Medicaid is where you want to land, those proceeds, once you sell a house, will now become income, which Medicaid can spend down. Well, let's talk about insurance with this, and just talk about the other part of it. And this is probably the most thing that probably you're thinking mostly it's your most way of handling this. But as we've talked about so far, there are others. And why do you want to do this for life insurance? It's all about leverage. Let me give you an example. If you have, and this is based on real premiums. So if someone is paying $700 a month, would say, wow, it's a lot of money. But from that $700 a month, and this is a real example, it's actually more than this, but that $700 a month, they have $700,000 in benefits. So that's 1,000 times the equity. Now that's for 1 month's premium. It gets less and less than that as you keep paying this. But you can see the leverage that you have with this. As we say, this ratio, the 1,000 ratio will drop, but it'll probably still have leverage. There are some things to talk about from some of these hybrid products that are out there, but they can provide 2-3 times the leverage with a single premium, or if you pay on a monthly basis. So it's big leverage. Maybe it's the biggest thing to think about. And if you're looking about leverage, you're thinking, well, I'm just going to go back and fund this myself. You need to think about what that means with that. What that means. For instance, if you have $1,000, as according to the SEC, if you have $1,000 and you had let's say $100,000, and after 10 years you get 5% return on it, you'd have about $162,000. You get a 7% return, you get $196,000. So basically, you're doubling, you're tripling, but it's not going to be as much as you would have if you have the leverage of insurance. Well, let's talk about the types of insurance: long-term care insurance, partnership programs, which we talked about briefly, and we'll talk about something that is that's not also looked at. But if you have life insurance, you can also have a long-term care rider. And we'll talk about the hybrid insurance, which are I guess, not as new anymore, but which are probably the more popular way of looking at long-term care insurance. And we'll also talk about short-term care insurance, which sometimes gets short shrift, but it's something that is very affordable, and that's something that can provide you, at least in the interim, some protection, substantial protection. Well, what is long-term care insurance? Well, it pays for all the costs that are out there. They do pay for assisted living, nursing home, in-home care, all of those, and there are restrictions on that. For instance, if you have home care, It has to be through an agency for the most part, but it covers those types of services. They usually have dollar limits and amounts. It could be 250,000, it could be 500,000, it could be 800,000, depending on what you decide to buy. And they usually have monthly limits with this, so you might be able to draw $3,000 a month, $5,000 a month, whatever it happens to be. That's part of the policy with that. They typically have a waiting period. Someone in the last presentation said, is there always a waiting period with this? There is, and the waiting period is typically 3 months. So even if you have long-term care insurance, you can buy something that will that'll pay for more than that, but that pays maybe from day one. There's some things out there, not many of them, but what that does, it increases the cost a whole lot. So you might be able to get coverage faster, but you're gonna lose a lot of the protection. But typically it's 3 months. And long-term care insurance can't be canceled except for non-payment of premiums. They can increase, however, and they will increase, but you can't be canceled no matter what your health situation is or becomes. And these rate increases could be significant, and depending a lot on long-term care insurance with this. To be honest with you, long-term care insurance is not as readily available as it was a while ago. A lot of companies entered this market and saying, well, this is great, and people are paying these premiums, but I'll go back and I won't have to pay out for quite a long time. What they found out is that first, that people hold on to these policies, if people don't drop them out, they're waiting to cash in on it if they need it. And also interest rates were not nearly as high as they thought, at least at the time when these long-term care companies out. So there's really only a few companies that really offer this long-term care insurance anymore. And the other thing about long-term care insurance, they are medically underwritten. So if you have some significant health issues, it may not be an option. The only way to find out is to actually apply and see what happens, but it's something that this may not be available for everyone. The other thing, it's that long-term care insurance is you get no equity from this. It's like your auto insurance and car insurance. If you have homeowners insurance and your house doesn't burn down, well, you don't get that back. If after you sell your house and say, my house didn't burn down, I want the money back, it's not like that. It's like it'll cover you for long-term care expenses for that period of time when you're paying premiums. Even though you can have things where you have you can get some kind of return of premium. There's some fees like that, but every time you do something like that, you diminish your protection. And again, it probably provides the most leverage. Okay, the partnership plans are long-term care insurance plans, but they have something special with those. And they look like the other long-term care plans, but they have this asset disregard. Remember with the Medicaid, we're saying, well, you can disregard money that may go for the spouse, or you can disregard certain assets for the spouse. You can also disregard anything that long-term care pays out. Like for instance, if you have a partnership plan and they pay $50,000 in benefits, then those $50,000 are not counted against your asset limitation. So actually, basically what the long-term care partnership plan, it does go back and protects $50,000 in assets in this case. And again, you have a low amount of assets. If you had only $2,000, at least you'd have $52,000 in this case. They always include the inflation protection. So these policies are on the more generous but more expensive also type of policies. And some of the strong points about long-term care insurance in general for long-term care insurance and partner plans is the big things. You have money basically to pay for things. And you're going to be able to probably be able to stand first in line if you have money. That's kind of the way it'll work. And you've got flexibility on what types of care you want. And you get the maximum financial leverage. And sometimes you can sometimes have monthly, quarterly, or you can always get all, say for most part, monthly, quarterly, annual premiums. So it's something that you can, you're not drawing your assets down quickly with this. And there's also a greater chance you're going to get the providers you need if you say, I've got long-term care insurance, until put you ahead of the line again. Difficult issues are you may not qualify if you have pre-existing conditions, and the premiums will increase with age. and there's no equity in it, as we mentioned. This is strictly, you might have a return of premiums where you can be able to get your premiums back. That's kind of a little gimmick. It's almost like a life insurance gimmick for that, but for the most part, you're not going to have anything for your premiums with this long-term care insurance. This is what is typically most people think of as long-term care insurance. And also, you can need separate policies for each spouse. There are some programs that have kind of two-person discounts, but for the most part, it's you need an individual policy for each spouse. Well, another part about life insurance, I'm kind of flying through it with a little bit so we can stay on time, but life insurance, sometimes you don't have to think about, this is whole life insurance. This is not term insurance, but they also have some insurance with riders. Life insurance is, has cash values built into it, but you also have insurance. You have a face amount, which says, okay, if you pass away, it's $100,000, and then the cash value is whatever it builds up to at that time. But if you have a rider with this, and you can't perform 2 or more of the activity of daily living, this could vary by company, but it's typically what they have. You can't eat yourself. You need help getting out of bed, those type of things. Then you can get actually benefits up to for whatever the face amount is. So if you have it's $100,000, you might be able to get, you can start and you qualify for that. Then you can get long-term care benefits out of your life insurance. And of course, if you what you have out there, it's it'll reduce the face amount of life insurance, but it's at that point it's something that you can provide you with this care if you want to use it. You don't have to exercise it. So it reduces the face amount, and the strong points about this, it's less rigorous underwriting than the standalone long-term care plans that we looked at. And the monthly premium payments, so you can you can monthly payments. You don't have to do upfront payments. It's like regular life insurance, and again provides you that cash pool. So this is a way of life insurance that is out there. That is something that you can use, but it is only up to the face amount with that. That's the whole thing. If it's a $100,000 policy, you might have $100,000 long-term care benefits. Going through the process we went through, we have to figure out, was that enough? And maybe it's not, but maybe combined with other things, it might be. That's why it's important to think of these things as elements of your defense for long-term care, and not always your total solution. Well, let's talk about hybrid long-term care, hybrid life insurance. Well, what is this? It's a combination of long-term care benefits and life insurance in a product. And it pays a long-term care up to the face amount of insurance, just like the rider would. But the biggest difference is they have additional insurance that's available. So if you have a $100,000 hybrid policy, you have that available. But you'd also may be able to continue that beyond the $100,000. Sometimes there are some plans that'll say the amount you withdraw is $5,000 a month. There are some plans, a hybrid plan, that will provide you with life insurance that would be $5,000 for the rest of your life, if that is the case with that. So it's almost like, well, life insurance will pay up the face amount, whatever that is. Hybrids will pay the face amount plus, and that's the plus is why they have interest in these products, and they're a little bit different with that. But it has some of the same rules as life insurance, waiver of premium. I won't go through all those, and usually paid in an upfront single premium. But you can also have the policies we pay in 10 or 20-year install, paid up in 10 years or 20 years, something like that, which is a big benefit, because if you have a hybrid insurance and say it's $100,000, and unfortunately you have long-term care that comes up at the first year, well, you can still have the benefit for this, even if you haven't paid up the each of the 10 years or 20 years amount for it. So hybrid insurance has flexibility, and they're all a little different with that, and you have to be careful of it. So, but it's really more, it's not just traditional life insurance, it's traditional life insurance, a face amount plus a lot of extras, and you need to look at those specifically and see how they work for you. They even have some policies that cover both spouses, and again, there are very different policies that are a lot different. Some of the strong points, You can increase your coverage by multiples by 2, 3, 5 times, and even indefinite, depending on the policy. But it provides life insurance equal to that, I should say, life insurance up to the face amount of the single premium. So, like if you have a single premium if you have a face amount of $100,000, you're not going to pay $100,000. You're going to pay less than that. Otherwise, why would you buy the insurance? So maybe it's $50,000, for instance. So is how much you pay for it, but then you get $100,000 in coverage. That's just how life insurance works. So but it provides that you would have that life insurance, and then you also have the payment options available. And there are some joint policies offered by some companies, and you have to look at those kind of carefully. Again, the other thing is that with hybrid, and I should also say with this is for life insurance, is that these premiums will never increase. So whatever your premium is when you decide to take up the policy, that won't increase with age. It'll be the same, and you can't be canceled for this. The premium you pay, as long as you keep paying your premium, you're covered for life no matter what happens. And you still have a life insurance asset if you never use long-term care, you have something to pass on to your heirs. The issue is that you need a lot upfront to pay for this, even though that you can have installments. They are medically underwritten, but they're less stringent, and that they're other non-guaranteed, like other life insurance policies you have or other assets may have better returns with this. So you might be able to buy something that has a little better returns, but they're probably going to be competitive. But the biggest thing, you're probably buying this for the long-term care benefits. Of course, the life insurance, if you use it up, it's not going to be a financial asset or a benefit, but it might be worth it if you need it. You also have annuities with this, and they work kind of the same way. You can, it provides an annuity that keeps on growing, hopefully, and it's has some of the same conditions. It's reduced by any long-term care benefits, and it also gives you it's another way of providing this, and it's a little simpler with annuities and life insurance. Life insurance has a lot of pieces to it. Annuity is pretty straightforward. And again, you can get it so it pays multiples of your initial investment, 2, 3, 4, 5 times that. And it's less stringent medical underwriting, and long-term care benefits can be tax-free in some instances. And the benefits are guaranteed, and your premiums, and you still have annuity if you don't use your long-term care expenses. So that's the nice part about it. This, you need a large amount up front. With annuity, if you're familiar with annuities, you basically pay a big amount up front, and you get something back from that when you start drawing on it. And again, other annuities might have better returns, but if you're looking for the best return, you have to consider that they probably won't have long-term care benefits. Okay, you also, how can you get these sums of money? Well, one way is you can look at it probably comes down to a lot of people looking at your qualified funds, your 401ks, 403bs, IRAs, and saying, okay, I've got this money. Do I want to transfer or roll over some of these things so I can get long-term care protection? That's really what it will come down to. Sometimes these, if you do decide to, you might have required minimum distributions, and if you use those required minimum distributions, it could pay for those some of these benefits, especially if it's on, or at least some or all of it, depending on how big your requirement, your RMD, your required minimum distribution is. Once you have to take that out, it might be something to use to turn it back into protection for long-term care protection. Okay, that's one thing last thing I want to talk about, short-term care insurance. Well, what is short-term care insurance? Well, this covers usually home or institutional care, but usually for a year or less. Typically benefits might be $100, $300 per day, and they may have weekly maximums of $1,000.50. They usually start immediately with no waiting period, and they can provide for those gaps, that 90-day period we talked about, or if you need something right away. It's less rigorous medical underwriting, and they take applicants up to age 90. So it's some of them. So it's really something that is a lot more affordable. And if you wanted to give an example of this one, and this is somebody age 65, you get something that pays $300 a day for 365 days. With that, and that's for $10,000. No waiting period there's no waiting period for nursing homes for this particular policy. It pays also $1,200 a week for nursing home care for 52 weeks, and that has a premium about $170. Now, the interesting thing about this long-term care, this short-term care insurance, is the risk is not, it's a lot less for this because it's specified what it is. But these rates have been remarkably stable opposed to the long-term care insurance. So one of the things about this is that these benefits start immediately. It could fill those gaps in that you have, especially let's say if I have a lot of property, if I need long-term care, I'm going to sell this property. Well, you may need time to do that. You may need to see if the market's right. The short-term care will give those gaps and also gives you time to make decisions with this. And it's much less strict underwriting. They do have some, but it's less strict, and it's available for up to age 90. So that's something you can look at. And it's also much more affordable long-term care insurance for most people. The disadvantage is it only goes for 1 year, and it's once the year's out, you can't renew it. You have to figure out other options. So now we're running out, and I'm officially just going to go through these really quick. I won't go through it quickly, but I'll just mention what they are. Some of the factors you look at, your situation is going to change. You need to look at other situations that might happen. There's going to be, your life is going to change, and what will happen could change. Where you live is going to be really important, whether it's an assisted living home, whether it's another state. Some programs are available, sometimes they're not. And then if you have a spouse, you need to look at your decisions based on two people, and that makes a different dynamic. And you need to figure out really what your family can do or is willing and able to do, because that makes a huge difference with that. And you need to look at your assets to figure out what you can use to pay for this. And then finally, you need to balance your risk tolerance with your lifestyle choices, because it really, in the end, it really comes out to saying, okay, I'm going to take this risk. I'm not going to do anything. I'll see what happens, or I'll take something to minimize the risk, but I just can't cover it all because I need all this money to survive. But things change, and you need to be aware of that. I'm not going to go to the details of what I said because I'm running out of time. But just to go through, and that is, it's available on the PowerPoint, which is available for anyone. Family support. But there it is. There it is. No one can predict what your expenses are. How do you balance your financial risk over your lifestyle budget? It's difficult, and to figure out. But the biggest thing is don't wait till the last minute. Because it's if you do, you're going to be forced to making decisions, and maybe the wrong ones. If you're going to do, even if you're not even going to do anything at this point, you need to think about it. At least that's what I would urge most people to do. The longer you think about it, the more time that you have the best chance to achieve your outcomes, whatever they are. What can you do to help? Well, what we do basically is that we can help you with your plan, and this is much more complicated than looking at a Medicare health plans with this. So it's going to take a long time to talk about everything we just talked about, whether it's insurance or not. We're willing to go back and just help you think it through, basically, because it is your decision with that. And so we look at any kind of insurance products. We can go the full way with with explaining everything in detail, quotes, and everything else for this. And also, any numbers you see, you need to look at exactly what the numbers mean for you. I mean, if you need to get an exact quote. So if you're looking at things, you know what you're in for. It's like you're getting your roof fixed. You don't want a general quote. You want the exact quote for your roof to see what that means. And here's that's not me, but I'm the head of this organization, and you can reach me. If you call, you will reach me with that. And basically, we'll see how this works. And there's a toll-free number as well. But if you need help and you want to think through, even if you just want to talk through these things and whether or not it results in not paying insurance or not, that doesn't matter, at least at this point. But the reason I put this together is to say, okay, there's a big need out there. I've seen that need personally with family members, with friends and others, and I've got a lot of experience that can be helpful. But it's certainly up to you, and this is an offer to help if you need it. I'm glad to do that and be happy to help anyone. So again, thank you. We hope to hear from you, and I think that is it.
Well, thanks everyone for their
questions.
I will, we have some questions, and I will take over and become presenter here.
Thank you.
Let's see. Monitor 2. Give me just a second, and I'm going to go into, yeah, it's another one of my favorite photographs. So here you go. Can you see the slide, David?
Let's see.
Oh, let me. Yeah.
Oh, is that a question? Tax implications? Okay.
Yeah, there's a question mark at the end.
Oh, okay. All right. Well, if you use your if you take money out of it, and well, if you just say you don't have any life insurance at all at this point, and you decide that you want to take money out of your IRA, and it really becomes it really basically it means you're taking it out, and you probably will have it's not a tax-free, unfortunately, it's not a tax-free transfer for this. That would be taxable for you as if you take money out of an IRA to fund life insurance. There are some ways to kind of mitigate that, and I probably need to go through that in a little more detail with that. I'm going to provide, if you don't mind, this one is it's not quite as straightforward, but basically you probably will have some tax implications. And I'd like to maybe put together a little slide or a little piece for this. What would be the best way to have this available to answer this question? I can write something up and maybe have it available for someone. Is that the best way, or what's the best way, do you think?
Well, you can amend the presentation, but my advice is talk to your financial advisor and your accountant. They're much better versed on this sort of thing. But if you want to add something, David, I can put a slide in when I do the video.
Okay, well, let me do that. Let me put a slide in with this because I want to specifically address this, and and I want to check all the boxes to make sure I'm answering that question right.
Very similar question.
Yeah, if the RMD comes out, it does. Yes, they will. If it does come out, if the RMD is you're losing that tax status, and the IRS will basically be taxed on that. But again, if you're taking RMD out, you're going to be taxing it anyway. It's not a way to avoid an RMD with that, and or to take it's not a way to transfer your RMD to make it non-taxable. I guess is what I'm saying. These IRS collect the tax first, and the net amount is rolled over. Yes, basically that's it. I mean, you will have that tax. You'll get the money back, but you'll be taxed on it, and that net amount is available for long-term care insurance, whatever you have. But again, I'm going to address that in that same question with life, because it's pretty. Okay, I have John Hancock long-term care policy since 2005, which covers nursing home, alternative care, or community-based home coverage. Thus, updated language also include what are now called assisted living facilities. I don't know exactly what's in that policy, but from what you're saying and knowing a little bit about John Hancock, when it says alternate care facilities, it probably should include assisted living, because in 2005, at least, they were using the term assisted living at that term too. But what I think you need to do is look at that, and if whoever's written that, if you'd like to send me a portion of it, or at least your policy, and I can probably tell you for sure. But normally, an alternative care facility means assisted living with that, and it's but the only way to 100% check that is to look at the language, the exact language in your policy. And if you would let me take a look at it, I'd be happy to do that. If whoever's asking the question, you can contact me, and if I can get a copy of that, then I can look at your policy to be sure. But about 90% sure that's going to be the case. But I wouldn't want to say 100% sure until I actually look at the language and make sure that it does say that.
And David's contact information is part of the slide set that I sent a PDF out in the handouts. It will be on our website if you want to get a hold of him. And of course, you can always send your questions to the NCRO too, and we'll make sure they get passed along to David. And I'd like to, I guess at this time, I'd like to take a moment and thank David for spending a couple days of his time and for putting together this amazing amount of information. Hopefully it's been helpful. I know it was enlightening, a lot enlightening for me. There's things that I certainly didn't know. So with that, I'm going to basically end the webinar. We're done with our questions, and the 2 videos should be out on YouTube. Everything should be in place, I'm guessing, by maybe next Monday. It may take until Tuesday to get the website updated, but I will send the links out to everybody that signed up for the webinar as a just to make sure you've got it. But thank you very much for taking the time, David.
Oh, thank you. I appreciate the opportunity.
Have a safe day.
You too. Thank you.
We're going to call her quits.
Thanks again, Dale.
Bye now. Thanks, David.